Running out of money in retirement is a common fear, but it doesn't have to be. In this video, I'll show you how dividends and bonds can work together to create a reliable, growing income stream that can last for life without being overly exposed to ups and downs in the market. The strategy I'll share is a little different from the most common retirement income playbook, which is the 4% rule. If you're unfamiliar, this approach has you sell off 4% of your portfolio's initial value in the first year of retirement and then increase those withdrawals annually by 3% or so to keep up with inflation. Lots of historical studies have shown that this approach can usually make a portfolio last for at least 30 years without running out of money, but it can still feel a little uncomfortable or even intimidating to pick a safe withdrawal rate since you never know what the future holds. If the market crashes early on in retirement, withdrawals could deplete your funds too quickly or force you to dial them down. Or maybe you'll be one of the lucky ones who lives well beyond their projected life expectancy. This chart shows what a safe withdrawal rate was throughout history for an all-stock portfolio in blue, an all-bond portfolio in red, and a 50-50 stock and bond portfolio in gold. You can see there is a lot of variation across each strategy depending on when you retired. If you were really unlucky and retired with an all-stock portfolio in the late 1920s, right before the Great Depression hit, a 2.5% withdrawal rate would have been needed. But if you kicked off retirement in the early 1980s with an all-bond portfolio when long-term yields were peaking, a 10% withdrawal rate would have proven safe. Basically, with the 4% rule, a lot depends on the prevailing market environment when you retire, since your portfolio's future returns from that starting point will drive your safe withdrawal rate. The S&P 500 currently trades at a price-to-earnings or PE ratio near 22, which is its highest level since about the dot-com bubble in 2000, and could reduce the stock market's returns in the years ahead if this valuation multiple returns to more normal levels. This chart from Goldman Sachs shows the market's annualized total returns over rolling 10-year periods, and they've ranged from slightly negative to about 20%. Given the S&P 500's valuation today, Goldman expects just 3% annualized gains in the decade ahead, which would be on the low side of historical returns and has led some experts like Morningstar to suggest a withdrawal rate below 4% is prudent today. Now, I don't put much weight on market forecasts since no one has a crystal ball, but this is where a strategy centered on dividend growth investing and bond interest can provide greater peace of mind. Instead of hoping for favorable market conditions when you need to sell off parts of your portfolio to meet the 4% rule, this strategy relies on the stable and rising income stream generated by your investments, potentially without ever having to sell a single share of stock. This can alleviate worries about the market's total returns and how stocks will perform in those crucial initial years of retirement. Here's a high-level look at how this strategy works. I put together a hypothetical $1 million retirement portfolio, invested 70% in dividend growth stocks and 30% in bonds. The chart here is plotting the portfolio's annual income generation along with those sources of income by different color codes here, starting with an initial withdrawal of $40,000 or 4% of the portfolio's value. The assumption I baked in here is that on the dividend side, which is again 70% of this portfolio, we're shooting for a 3% starting yield with 5% annual dividend growth. So we're not reaching for risky stuff that's yielding 6%, 8% to try and make this work. That's completely unnecessary and not a good idea for a long retirement. And we're baking in a growth rate that's actually below the S&P 500's long-term dividend growth rate average. So these are fairly conservative assumptions, which we'll kind of take a closer look at later. On the bond side, we're just looking for a 4% yield and structuring this side of the portfolio in a way that allows for either bond sales or regular maturities to help make ends meet as that portfolio gets worked down over time. Now, let's look at how this all comes together. So in year one, 2025, the $40,000 of income, about half of it is coming from dividends in orange, and then the remainder is split between interest from our bond portfolio in dark blue, and then either selling off some short-term bonds or allowing some of the bonds to mature in green and using that cash also to hit our initial withdrawal. So 0 stock sales are required here. We're just relying on dividends and the bond side of the portfolio, which is stable and safe income coming from treasuries or very highly rated corporate bonds. And that pattern continues actually for quite a long time. You can see the green bars selling off our bond portfolio kind of slowly increase over time. As we sell off parts of the bond portfolio, the income from the bond interest decreases over time. And while that's happening, what's really interesting is the dividends are growing. And now it's 5% a year. It may not sound like much. We're not putting more money into this portfolio. We're not reinvesting the dividends. They're being taken out as cash for living expenses. But the power of compounding is tremendous, because this initial base of dividend income at $21,000 is going to reach about $60,000 by the time our bond portfolio goes to zero. So this will happen in about 22 years. And at that point forward, to meet those withdrawals, which have also nearly doubled due to the effect of inflation, we'll have to sell off parts of our stock portfolio. But these blue bars here, they might look big and scary, but by that point in time, this chart I'm showing you here is plotting the value of our portfolio. And it puts these stock sales in perspective, is what I'm getting at here. So you can see this purple line, a little hard to read. That's our bond portfolio. It goes from a starting value of $300,000 to zero after about 22 years. But our dividend portfolio, this black line here, starts at $700,000. And if we assume that portfolio keeps trading at a 3% yield, as that dividend income stream grows, our portfolio becomes more valuable. So by the time our bond portfolio is gone, we're generating about $60,000 of dividend income. At a 3% yield, you would expect this stock portfolio to be worth over $2 million at that point in time. You have less than 10 years left in your retirement window, and these stock sales that would be needed to meet that withdrawal needed would represent less than 1% of the portfolio's value. So if all these assumptions kind of played out to our forecast here, you'd be sitting on a portfolio worth twice as much as when you started, not adjusted for inflation, and could be sitting on a pretty good nest egg because you never had to sell a single share of stock up until this point, which you could either, maybe use a more aggressive withdrawal rate if things were going well during retirement earlier years. You could look to earmark it as kind of leaving a legacy for the next generation behind you. You could look at making a large charitable gift. You have a great flexibility is the main point here, and your income stream is still being dominated by this rising passive income from dividends, with a very low dependence on what the stock market is doing. Not just the first 22 years, which you have no stock sales, but really from this point forward as well. You could put in place a much more aggressive withdrawal rate if this played out and you were sitting at over $2 million with your stock portfolio remaining. But you might be looking at this and thinking, gosh, this sounds too good to be true. Can you really kind of achieve that type of outcome, especially on the dividend growth side, which is a really critical driver of this model? And I think the answer is yes. Let's take a closer look at that. Starting on the bond side, we were targeting 30% of our retirement portfolio's initial value to be invested in fixed income at a 4% yield. I'm on Schwab's website right now just to show you. They have this really handy table that shows different types of fixed income securities, CDs, treasuries, corporate bonds, municipal bonds, across different durations, 3 months all the way to 30 plus years. And what I want you to see from this is right now you can get that 4% plus yield across all these time horizons. The yield curve is quite flat right now. So this makes it very easy to kind of put together some sort of ladder, is what it's called, where you have a set amount of CDs and bonds maturing every year that can then be either reinvested or taken as cash, which reduces the risk of interest rate changes impacting the value of the bonds that you hold. So it's a very good time to kind of lock in a 4% type of yield. I think that's a very realistic target in the experiment I was showing you earlier. Now, the dividend side is a little bit more complicated. I'm going to use our website, simplysafedividends.com, to show you how we could put together this type of portfolio that is going to be 70% of our retirement portfolio, targeting that 3% yield with 5% growth. Now, what I did here was I used our stock screener. I saved a screen actually that I used to put together a portfolio, an example portfolio that's accomplishing this goal. And what I looked for were stocks that yielded between 1.5% and 4.5%, so kind of getting a range of both low yield but high growth and some higher yield with slower growth. I wanted all these companies to have raised their dividend in this past year by at least 5%. I wanted companies that have had a dividend growth streak of 5+ years, so they've shown some consistency with keeping their dividend rising. I also filtered this list for quality, looking at only companies that have an investment grade credit rating from S&P. as well as a safe or very safe dividend safety score from us, which I'll talk about more later. And I also ruled out things like MLPs that issue K1s. I'm just looking at qualified as well as non-qualified dividend payers like REITs and BDCs, no foreign companies or issues with withholding taxes. The final metric I put on here was looking for stocks that appear reasonably valued or undervalued using our criteria. And this boils down to 60 names today. So I went through this list, and I mean, you're going to see a lot of really good businesses like PepsiCo, Merck, utilities, some very defensive companies here, Amgen, Mondelez, lots of blue chip businesses, Coca-Cola. So a lot of household names here. And I went ahead and tried to create just a simple 25 stock portfolio valued at that $700,000 initial investment from our retirement portfolio that yields 3% today, good for about $21,000 of annual income. And importantly, this portfolio with how it's constructed today, I mean, history is not guaranteed to repeat, but you can see we didn't just get a portfolio that's income has grown at 5% per year. We've been seeing dividend growth of 7% per year very consistently. Last year, the last 5 years, the last decade. It's a really powerful concept. You can look at an example. We have Chevron in this portfolio. So over the last 5 years, Chevron's income has increased from $890 to about $1.2 thousand. And that's just based on the shares we would have owned over this whole period, the 187 shares in the portfolio. No additional contributions from us, no reinvested dividends, just pure organic dividend growth from this oil major. So when you put that all together, we can look at our income forecast report here. So again, we're not reinvesting dividends. We're not making any annual contributions. If our portfolio's dividend growth continued at the current 7% rate we've been seeing, which would, again, far exceed the 5% level, our income could grow from about $21,000 today to over $80,000 20 years from now, again, when that bond sleeve would be depleted in our portfolio. If we kept a more conservative growth rate of just 5%, our income would grow from about $21,000 to $55,000 over that period of time, tracking with that chart I showed you earlier. Now, the portfolio itself is pretty well constructed. When you think about the markets today is extremely concentrated in tech stocks, our portfolio is extremely diversified. No sector accounts for more than 16% of its value, led by predictable defensive businesses like consumer staples. You got Procter & Gamble, Pepsi, Coke, as well as utility stocks, which are also a 16% weight. WEC Energy, NextEra Energy, AEP. So a lot of really great businesses. Healthcare is up there at 12%, all the way down to energy, tech, kind of get lower weights. They can be more volatile areas for dividends, or tech in general just has smaller dividends because those companies are so growth focused. Our income sources are very diversified as well. Even though we only have 25 stocks in this portfolio, you can see only one stock, Chevron, accounts for more than 5% of our income. Clocks in at about 6% there. Chevron itself is just an iconic dividend payer. They've paid a safe dividend for over 110 years. We think the dividend continues to look safe for this business. They maintain an excellent balance sheet, very low leverage levels. So whenever the price of oil crashes, they can borrow to keep that dividend strong until conditions and prices recover. They earn a AA- credit rating from S&P as well. So a very diversified portfolio here. It's had dividend growth that has exceeded the 5% rate we're targeting. From our lens, the dividends look quite safe over a full economic cycle. 100% of the holdings here are in a safe or very safe dividend safety score from us, which I'll talk about more in a second. And that's really the biggest risk to this type of strategy. So what you're checking out here is a chart of the S&P 500's dividends over time. And dividend cuts would obviously cause problems to this income strategy, right? We're assuming kind of steady 5% growth over the years. But if you look at the S&P 500's history, when there's recessions, like here was the dot-com bubble, here's a financial crisis, that recession in particular was really tough. S&P 500 dividends fell, I think, about 25%, and then obviously took a number of years to kind of get back to that high watermark and continue growing over time. So you can see that the dividends have grown nicely over the last 50 plus years, and here's COVID here. You can see like a little dip. But you have to be ready for whenever the tide goes out and build a portfolio that can overcome these recessionary periods where dividend cuts tend to jump. And that's what we spend most of our time doing at Simply Safe Dividends. So we maintain a real-time dividend track record showing all 858 dividend cuts we've seen since we've been in business in 2015. And we show you the dividend safety score we had on that stock before the cut was announced to show the predictive value. Now, there's never going to be a perfect system, but investors who stuck with companies that continued to earn safe or very safe dividend safety scores would have avoided over 97% of these cuts that occurred. So what does that mean in reality as well? Well, let me pull it up here. We have a few different model portfolios that I actively manage in our newsletter. I'll show you this conservative retirees portfolio. It's very similarly constructed. I'm a conservative long-term investor. And you can see since 2015 when I started this portfolio, the purple bars are the dividend income it's thrown off. They have marched steadily higher like clockwork here, including COVID, which is really the first big test. Our income increased that year, even though the value of our portfolio and the market, which is shown in blue, temporarily dropped. That really shows, again, the power of this rising dividend strategy. Instead of really wringing your hands here and worrying about, okay, what do I do? Is the market going to stay down? Is this pandemic going to get worse? We could see that, hey, our companies are still maintaining and actually growing their dividends during this event. Our passive income stream is intact. We don't need to worry about selling shares. We go about our business as best we can and get some peace of mind from those dividends. So that's the goal of this portfolio. Now, certainly some of these companies could run into some hard times. Maybe their pace of dividend growth is slowing. That's to be expected. You know, a portfolio like this, I wouldn't expect to make more than 1 or 2 trades per year on average. That's what I've kind of done in our model portfolios. But some companies will inevitably hit some hard times and need to be replaced. But for every one of those, there's going to be a handful that are exceeding expectations, enjoying very strong dividend growth and healthy total returns to keep that portfolio's value growing and its dividend stream overall safe and rising. So I'm flipping through here. I tried to show you some columns that would be helpful to get a sense for this portfolio, showing the sector and industry, our dividend safety score, the yield chart, latest dividend growth. We have S&P's credit rating tucked over here. There's actually dozens of columns you can choose from and even rearrange in your own portfolio to get the exact look you want as you oversee your investments. But you can see a lot of great businesses in here, including some dividend aristocrats like Abbott, Accenture, ADP. Comcast has had some growth challenges, but is still kind of a low expectation cash cow. Looking at our valuation chart here, the stock is trading much cheaper than it usually does if they can kind of fight back in the battle for internet subscribers with some of the wireless carriers. We published a research note on that recently if you wanted to learn more about that issue and shared some of our thoughts. But this is a portfolio here. So lots of very time-tested businesses that generate reliable cash flow. Even when there's downturns, you're not just getting the dividend, but if I can add in here, there's a column called recession return. Here it is. So this shows you how the stock did when the S&P 500 fell 55% during the financial crisis. And you can see these defensive kind of blue chip companies that generate great cash flow typically outperform when investors are fearful, which we haven't seen for a couple of years. But here's McDonald's. Went down 3% when the S&P 500 was off 55%. Abbott down 13%, WC Energy 18%. Qualcomm did well. Maybe that's the smartphone adoption that was doing well back then. But you can see this portfolio has a lot of businesses that outperformed significantly during the last big scary recession when dividends were being cut, and they maintained their dividend payouts. Dividend growth streaks here, you can see we have some companies that have raised their dividend every year for almost 70 years. So I think when you think about the biggest risk to this approach, which is dividend cuts, you have to actively manage your portfolio. But that's where we try to really help investors out with both our research notes, all the time we spend on dividend safety analysis, as well as just our tools to make it really easy to kind of stay in the loop on what's happening with your holdings. And by the way, you don't just have to have individual dividend stocks. A lot of people will own a combination of stocks and funds like SCHD, which can provide additional peace of mind with trying to reach those goals and be well diversified. In SCHD's case, you can see the yield is a lot higher than the 3% we were targeting, and it's been throwing off double-digit growth. You just have a little bit less comfort and visibility with these ETFs. I kind of like being able to know exactly what I own, see what's happening with each company, make sure they're all still working together to kind of meet my long-term needs, which in this case is that 3% yield and 5% plus growth, which I find to be a pretty achievable target over the long run and really adds up to a super powerful retirement portfolio without needing to rely on share sales so much. So I hope this video was really helpful if you're trying to figure out how to possibly make ends meet in retirement. Maybe you're already doing a strategy like this, and it's kind of reassuring to see some real life examples and companies that can help this strategy work for many years into the future. If you enjoyed the video, it would really be helpful for me and my work if you considered hitting the like button and subscribing to our channel. I typically will post a few videos a month focusing on analyzing dividend stocks and talking more about this type of strategy with none of the nonsense or guru stuff you see out there. So thank you for watching, and I hope to catch you next time.